Welcome back. Let's turn our attention now to NIIT Limited. Now, earlier there used to be this one NIIT company. Then it got demerged into two entities. One is the B2C business, which is NIIT Limited, and the other one is the B2B business, where their clients would be enterprises who are looking to train their own employees, right? This is a company which has been into learning for the last so many decades. So the company that we're now talking about is NIIT Limited, which largely caters to training and upskilling skill enhancement, upskilling individual, people. So they get about, I think 60% of their revenues broadly from technology, and the balance comes in from BFSI and, other verticals. But now the technology bit, technology hiring has gotten impacted because companies are not hiring that much. So we'll, invite the management, Mr. Vijay Thadani, on this show now to talk about the outlook gone by. We also didn't get a chance to chat with the management when they reported their Q2 numbers. Mr. Thadani, morning. This is Rima here. Despite a quarter-on-quarter pickup in revenues that we've seen for your company, you're still saying that the full year revenue growth for the company will be flat or marginally lower. And your earlier guidance was for a single-digit kind of a revenue growth. So what does this mean in terms of an H2 performance? And can you talk a little bit about the technology hiring? Because of your dependence on technology, that's gone through a bit of a downturn.
Okay, thank you. First, I want to compliment you on the way you were explaining our company to your colleague. I thought you did it better than we do.
Thank you. That's very kind of you, but...
No, so what I want to explain to you is, see, we were actually going along pretty well during the previous financial year, and in the Q3 and especially Q4, when the GSI hiring completely stopped, and the IT services numbers, and that in the first, and that has continued in the current year. This year, I think for the first time, we have a negative hiring scenario in the sense these companies have given up more people than they have hired. So in that, obviously, that part of our business has been affected. On the other hand, what we did was, which turned out to be a very, very good strategy even going forward, is that we focused on Tier 2 GSIs and GCCs and the sector which was doing well, which was BFSI. So we encountered success in all these three. GCCs are on a big hiring spree because they want specialized people. They want to make sure that their L&D functions can service the needs of their businesses well. And I think we encountered success. So both in terms of early hires, but more so in their current workforce in transformative training, because technology changes is just continuing, and in fact, it is accelerating. So therefore, there is a great need for them to re-equip their workforce. Now, the good news is that covered the gap to quite an extent. And that gap will get fully covered when GSI start hiring. Why are we forecasting slightly lower revenues? That GCCs as well as Tier 2 GSIs obviously are not able to make up for all that GSIs are not, the Tier 1 GSIs are not doing. But when that starts happening, this new segments that we have now encountered will sit on top of that growth, because that GSIs will come back and will start, as they start hiring, we will notice that and we'll start seeing the growth going there.
So, Mr. Thadani, 66% of your revenues is dependent on technology. Can you break that up further into Tier 1 GSI, which for simplistic purposes for our viewers, we'll call them Tier 1 IT companies. Secondly, can you tell us the Tier 2 IT companies? And the third one is GCC, the Global Captive Centers, because you are seeing a pickup in hiring from the Tier 2 companies and the GCC. So break up the revenue contribution.
Yeah, I would not be able to share that with you right away, and that's not something that will be immediately available, and I don't want to make a guess. But sufficient to say that if Tier 1 GSIs become nearly silent, then the rest of the revenue has come from Tier 2 GSIs as well as GCCs. And I would say in approximately equal measure, maybe 60% out of GCCs and 40% out of tier 2 GSIs.
Okay. God, that's so we'll watch out for trends on this front and how GCCs pick up their hiring if they do. Let's also talk margins. You've been guiding for single-digit margins. Now, can you sort of give us a little more color on this? Does it mean, around the 2.5% to 3% vicinity? Could it get better than that as we, gear up for next year, FY25?
Yeah. So first of all, there is one part of our business which is to reach out to the early career students directly. One is to go through the enterprises. So as we explained from time to time, a fresh graduate either gets campus hired. If he gets campus hired, he would get trained by NIIT when he joins the enterprise. The ones which don't get hired by campus hires would go to our digital centers and would get themselves equipped and again join the workforce. Last year, we serviced 19% of the fresh hires. Last year in FY23, we serviced 19% of the fresh hires that the all IT industry hired. Now, this year, of course, that part is subdued. In that transformation phase, we are still tuning tuning the products, tuning the product market fit, and that is in an investment phase. That is the reason you see the margin to be slightly to be subdued. In steady state, that margin should be much higher. And I think we will start encountering that steady state as we go forward in next 4, 5, 6 quarters. That obviously also is dependent on how the environment performs. So I think that would be the right answer. So right now, one part of the business is an investment phase. And in that investment phase, I think the margin would be subdued. The part which is doing well is delivering mature margins.
I remember you've said the steady state margins for the company are about 15 to 16%, but you are investing, which pulls down your overall margin. Just a last word on your cash. Your cash balance is nearing 700 crore rupees. You have M&A plans. You have an aspiration to hit 1,200 crore of revenues in the next 4 years, and about 1/3 or 1/4 of it is going to come in through the acquisition route, inorganic. Are you likely to close an acquisition this year, or is it going to be an FY25 exercise?
Well, acquisitions happen when they happen, so very difficult to
But
time
is it in the pipeline right now? Are you close to?
Yeah, we are in a number of discussions and at various stages of an acquisition process. And I think the best thing for us would be to comment on it once something is done.
Okay, can you just give us some hints? I mean, what space are you looking at where these might actually, finalize?
Our acquisition strategy, number one, is not to buy revenue, but is to either add a new capability or a new segment or a new geography. So in this case, the new segment can be a new market segment. For example, right now we work in technology, we work in BFSI, and there are other segments which are opening up. And I think those are the segments that we could be looking at. I'm just giving you colors of all that is possible. The second is some capability. That capability may be a certain way by which training gets addressed, some new methodology. And the last is geography. We have geography, of course, we cover India, and we cover the Southeast Asian markets, and the geography could be in any one of these places. But typically, these are the considerations that we have.
Got it, Mr. Thadani. Good talking to you today. Thank you for joining in, and we look forward to those announcements coming through on the M&A strategy as well. Well, with that, we do have to turn our attention back to the market, which has had a sizzling Friday so far, the Nifty hitting fresh record all-time highs. Mangalam is now standing by with details on all the big market moves since the last high, which took place on the 15th of September.